Hello guys, welcome back to my channel. Today I am discuss about fundamentals of mortgage law. This article is written by Luigi Frascetti. A mortgage is an interest in an land created by the contract, not a loan. Although almost all mortgage agreements contain a promise to repay a debt, a mortgage is not a debt by itself. It can be better characterized as evidence of a debt. More importantly, a mortgage law is a transfer of a legal, equitable interest in land on the condition of sine qua non that interest will be returned when the term of the mortgage contract are performed. A mortgage agreement usually transfers the interest in the borrower's land to the lender. However, the transformer has a condition attached. If the borrower performs the obligations of the mortgage contract, the transfer becomes void. This is the reason why the borrower is allowed to remain on title as registered owner. In practicality, he retains possession of the land, but the lender holds the right to interest in said land. In essence, therefore, a mortgage is a convenience of a law as a security for payment of the underlying debt or the discharge of some other obligations for what or which is given. In a mortgage contract, the borrower called a mortgagor and the lender is mortgagee. The history of mortgage law. Mortgage law originated the English feudal system as the 12th century. At that time, the effect of a mortgage was legally convey both the title of interest in land and possession of the land to the lender. This convenience was absolute, that is subject only to the lender promise to reconvey the property to the borrower if they specified sum was repaid by the specified date. If, on the other hand, the borrower failed to comply with the term, then the interest in land automatically become the lender's and the borrower have no further claims or resource at a law. There were, back in feudal England, basically two kinds of mortgages. Ad vivum medium, Latin a leave plates, in which the income from the land was used by the borrower to repay the debt, and ad mortem vadium, Latin a debt plates, where the lender was entitled to the income from the land, the borrower had to raise funds elsewhere to repay the debt. Whereas at the beginning only lay pledges were legal and debt pledges were considered an infringement of the laws, usury, the religious techniques. By the 14th century, only debt pledges remained were all very legal and very religious. And apparently they are still very religious in the 21st century. Express contractual terms of a mortgage. Following is an analysis of the clauses contained in most mortgage contracts. It should be emphasized, however, that the wording varies from contract to contract. That types of clauses change to conform to the particular types of securities mortgaged. Number 1. Redemption. When the mortgagor fulfills his obligations under the contract, the mortgage will be void. The mortgagee will be bound to reconvey the legal interest to the mortgagor. Transferability. All the covenants made by the mortgagor will be binding upon him, his heirs, executors, and administrators. This is the case whether legal interest has held by the mortgagee or by the mortgagee heirs, executors, administrators, and assignees. Number 2. Personal covenant. The contractual promise made by the borrower is in his personal covenant. Because of his, it does not run with his land, so that the lender can sue the borrower on his personal covenant, even in the eventuality that the borrower has sold the interest in land to someone else who has assumed to mortgage. In practicality, this means until the original mortgage contract is valid, it in full force and affect the original mortgagor. Number 3. Title integrity. The mortgagor confirms and guarantees that he is the owner in fee simple and holds all rights and powers that such ownership entails, including the right of the convey to the lend to the mortgage. Number 4. Free and clear. This is the very essence of the security for the debt. The title must be free and clear of all encumbrances, subject to certain statutory rights such as taxations, so that convenience can take place. Upon convenience, the interest is transferred to the lender to any embers to priority. This can be tax lien or, in the case of default on a second mortgage, a first mortgage. Further assurances. In the event of default, the mortgagor promises to do all that is necessary to allow the lenders to obtain title of the property. Number 6. Prior embraces. Except the statutory embraces, the mortgagor must make a declaration of any charges to priority over the mortgage being contracted. Otherwise, the lender expects has the right to register in his first priority. Number 7. Insurance. The mortgage convenes to either keep the buildings located on his land insured all time, in alternative to provide a cash bond covering replacement of said buildings. Number 8. Release of all claims. The borrower gives up any claims he may have against the lender with respect to the property, except the borrower right to demand reconvenience when the underlying debt is repaid. Number 9. Acceleration of default. Acceleration is a proviso stipulating the default, the principal and the interest of the underlying debt with both become due and payable forthwith at option of the mortgagee. Quit possession. The stipulation that until default the mortgagor still have quit possession of said land. Number 9. Omnibus clause. In default, any payment of money to be paid by the mortgagor under the term of the mortgage contract, the mortgagee would must pay for the same, and the amount to said shall be added forthwith to the principal debt secured by the contract and carrying interest at the same rate stipulated to the contract. Number 10. The mortgagor has a duty and obligation to keep lands and the buildings thereon good conditions and in a reasonable state of repair, and furthermore he will not abandon or commit or stay anywhere on the mortgage property. This clause is intended to the safeguard the value of the security. The mortgage. Number 11. Advance. The mortgage shall not be bound to the advance, and a part of the money intended to the secured by the mortgage contract. For example, where part of the money has been advanced subsequently and the builder's lien to field against the land, the tender will require the lien to be removed before advancing further lands. Note to the builders lien to the priority over mortgages. Number 13. Sale clause. Also known as due on sale, the mortgagor agree to pay at the option of the mortgagee all principal interest of the underlying debt upon sale of the property. The clause effectively prevents the mortgagee from being assumed by everyone unacceptable to the lender. Obviously, the other option to the lender is not to call loan if the mortgagor sells to a buyer acceptable to the lender. In the absence of the clause, the mortgagee will be assumeable. Luigi Frascati. Luigi Frascati is a real estate agent based in Vancouver, in British Columbia. He holds a bachelor degree in economics and maintains a web blog entitled The Real Estate, which is the link where he find the full collection of the article, and the Lungi associated with Sutton Group, the largest real estate organization in Canada, and it is based on Sutton Center Reality Honor. Luigi is proud to be a Design Article Platinum Extrovert author. Your rating at the footer are very much appreciated. Thank you. That is in for today. Please like, comment and share this video, and don't forget to subscribe my channel.